Good day, everyone.
I'm Maria Graces Belleza.
I am Gwyneth Mikaela Madelo.
I'm Ross Martin L. Macapagal.
I'm Rizzalyn T. Perez.
I am Princess Parami.
I am Nathaniel in Pamplona.
I am Stephanie Macatuggal.
I'm Allysa, Irish, and Sacristan.
I am Blane, Pili.
And we are Group 2, your today's reporters about financial planning tools and concepts. But before we start, let us know first our learning objectives. In the end of the chapter, we are expected to illustrate the financial planning process, prepare budgets such as projected collections, sales budget, production budget, income projected statement of comprehensive income, projected financial position, and projected cash flow statement. And lastly, describe concepts and tools in working capital management.
Financial planning process, since our chapter 3 is revolving around in a lesson about financial planning tools and concepts. Let me define first what is financial planning process. Planning is very much related to another management function, controlling. These two management functions reinforce each other, and both are very important for the success of an organization. Management planning is about setting the goals of the organization and identifying ways to achieve them. These may be broken down into long-term plans and short-term plans. Long-term plans reflected in a company's business strategy. In the process of planning, resources have been identified. These resources include workforce resources, production capacity, and financial resources. So sa madaling salita, ang financial planning process ay siyang proseso para sa ikaaayos ng isang negosyo. Kasi alam naman natin na sa isang business, mahalaga na maayos ang pag-finance dahil dito nakasalalay ang lahat na magiging kalalabasan ng isang business. Kung maayos ang papaplano nito, ay syempre magiging maganda rin ang resulta nito sa isang negosyo. So once a plan is set, it has been quantified. A plan that is not quantified is useless dahil walang magiging basis para sa pag-monitor ng performance ng isang company. And kung wala yon, paano natin masasabi kung successful nga ba talaga? These quantified plans are in forms of budgets and projected financial statements. So para lalo pang mas maging malinaw ang lahat, here's the steps in financial planning para masiguro na ang isang company ay talaga nga namang namamayagpag ito sa tinatahak nitong landas. First steps, set goals or objectives. Kahit anong klaseng plano, ang pinakaunang-unang inaalam ay kung ano at para saan nga ba yung plano. Ano bang gusto mong mangyari? At ganun din sa isang business. Meron silang tinatawag na mission at vision na kung saan nakalahad dito ang isang pahayag kung ano ba ang plano nila para makamit ang ninanais nilang kalalabasan. Tulad na lang ng nasa example natin, ang vision at mission ng kilalang Jollibee Foods Corporation. Jollibee Foods Corporation or JFC vision to excel in providing great tasting food that meets local preferences better than anyone. To become one of the 3 largest and most profitable restaurant companies in the world by 2020. Mission, to serve great tasting food, bringing the joy of eating to everyone. Second step is identify resources. Siyempre, hindi naman magiging isang business ang business kung wala siyang mapagkukunan ng mga bagay na kakailanganin niya para maipatayo at mapalago ang kanyang negosyo. Sa resources na ito, kasama na dapat lahat. Maski ang kakayahan mapalago ang mga produkto, mga taong magtatrabaho na siyang mamamahala sa operasyon ng kumpanya at syempre, ang financial resources na siyang pagkukunan para sa mga pangangailangan ng isang kumpanya. Then third step is to identify goal-related task. Kung may goal at objectives, dapat meron din mga task na gagawin. So example, target goal ng company nito is makabenta ng 15% more kumpara sa nakaraang benta nito. So syempre, isip kayo niya ng mga paraan para matupad yung goal na yan. Next step, step 4. Establish responsibility centers for accountability and timeline. So tulad nga ng example kanina, kung gusto nyo makabenta ng 15%, mas mataas sa una nyong benta, ay dapat alamin nyo rin kung sino-sinong tao at anong department ang hawak sa task na yan. So since about selling and marketing yan, dapat sa marketing department ipahawak yung task na yan. Step 5. Establish an evaluation system for monitoring and controlling. So kung may tagahawak at tagagawa ng task, dapat meron ding nagmamonitor kung nasa tamang landas pa yung ginagawa nila. For example, sa budgeting at financial statements, syempre magkaiba na yun, so dapat yung hawak nito ay siyang expert at marunong para hindi rin mapunta sa wala ang lahat. And lastly, step 6. Determine contingency plans. Di naman sa lahat ng pagkakataon nakikisama ang sitwasyon, kaya dapat laging may plan B, C, and D. Dapat lagi may reserbang plano para kung sakaling may hindi magandang mangyari sa unang plano, kaagad itong masusolusyonan dahil maraming naka-ready na plano. So, hindi biro ang pagpaplano for the financial planning. Hindi lang pagod at brain cells ang puhunan, kundi syempre sa malamang kailangan ng pera. Kaya naman for the next topic, we are going to talk about preparation of budgets and projected financial statement. Pero bago ang lahat, ano nga ba ang budget?
Budget is a description in quantitative, visually monetary terms of desired future result. The process of preparing the budget requires management at all levels to focus on the future of the business entity. So sa madaling salita, ang budget ay tamang paggastos ng pera para mapunta naman sa mga makabuluhang bagay ang bawat piso. Dahil sa panahon ngayon, ang pera ay napakalaga. Ano pa kaya sa isang business? Ilan sa mga halimbawa ng budgets ay una ang sales budget. Sales budget is a prediction of firm sales over a specific period based on external and internal information. The sales budget has constructed by multiplying budget unit sales by selling price. Again, to get the sales budget, it is needed to multiply the budget unit sales by the selling price. Para sa mas malinaw, kindly see the example sales budget here. As you can see, there are 4 columns and the last 2 columns have the quarter 1 and 2 budget. So para makuha ang kabuang sales budget, yung bawat kita, bawat quarter ay parehas minumultiply sa kung magkano ba ang bawat isa ng sales unit. At doon natin makukuha ang sales revenue para malaman natin kung nalulugi na ba o kumikita. Next example of budget is the production budget. Production budget is a financial planning related to the units of production that the management thinks that the business should produce in the upcoming period to match the estimated sales quantity. Based on the management judgment related to the competition in the market, economic conditions, production capacity, consumer prevailing market demands that the past trends. So meaning, hindi basta-basta ang pagbabudget ng isang kumpanya dahil hindi lang pala ang kita nito ang binabudget, kundi pati na din ang piniproduce nilang product. Tulad na lang ng example na nakikita nyo. Sa nakikita nyo dyan, mapapansin nyo naman na para makuha nyo yung production budget kada quarter, you just need to deduct the beginning inventory of finished goods sa total productions, and that will become the answer for the units to be produced. Next example of budget is what we call a cash budget. A cash budget is the financial of the firm that has planned inflows and outflows of the cash. It forecasts the timing of these cash outflows that match them with cash inflows from sales and the other receipts. The cash budget is also a control tool to monitor the way the company handles cash. So here, literal na pera na dapat ang i-budget. Kagaya nga ng paulit-ulit kong sinabi, napakahalaga ng pera. Kaya bawat piso matutulog tayo gamitin ito ng tama. Tulad na example natin ngayon. Assume selling price is 100 pesos per unit sales for each month that has expected to be collected as follows. Month of sales 20%, a month after sales 50%, and 2 months after sales is 30%. How much is the total receipts for sales? So para malaman natin yung kasagutan, tingnan natin itong table na nandito. As you can see, simula January to May ay may kanya-kanyang columns. And bawat column, naka-indicate yung bilang ng units. Magkano yung sales in pesos, collection from monthly sales, collection from previous monthly sales, collection from 2 months prior sales, and a total collection from sales. Para makuha ang collection from monthly sales, need lang natin kunin yung 20% ng sales in pesos. Para makuha naman yung collection from previous monthly sales, need lang natin kunin yung 50% ng bawat sales in pesos. Sa collection from 2 months prior sales naman ay kailangan naman kunin yung 30% ng bawat sales in pesos. After makuha lahat ng collection from sales, doon naman tayo sa total collection from sales. Para makuha yan, need lang natin i-add lahat ng collection sa bawat months, which is yung per columns. At yun na, tapos na yung ating cash budget.
Since tapos na tayo sa examples of budgeting, isunod na natin agad ang project financial statements. Pero bago yan, i-define muna natin kung ano ba ang ibig sabihin ng project financial statement.
Projected financial statements is a tool of a company to set an overall goal of what the company's performance and position will be for and as of the end of the year. It sets target to control and monitor the activities of the company. It forecasts or calculates the following reports: projected income statement and projected statement of financial position. So again, ang projected financial statement ay siyang ginagawa ng isang kumpanya para ma-determine nila kung paano sila gustong kumita at para na rin makontrol at ma-monitor ang mga gawain ng company nila. So, may dalawang reports tayo na pag-aaralan today at yun ang projected income statement at projected statement of financial position. As of now, unahin muna natin talakayin yung application of the projected financial statement approach. So there are 4 important steps na kailangan ninyong unawain at tandaan. Step 1. Forecast the income statement. Sa first step nito, kailangan nating magawa ang mga sumusunod. Establish a sales projection, project the cost of sales, prepare the production schedule, and project the corresponding production cost, direct materials, direct labor, and overhead from manufacturing companies. Estimate selling and administrative expenses, consider financial expenses if any, and lastly, determine the net profit. So para mas malinaw kung paano ginagawa ang step 1, kindly see this example at makinig kayong maigi dahil ipapaliwanag namin kung paano ito isa-solve. As you can see sa mga screen ninyo, may dalawang income statement kayong makikita. Yung nasa left side ay siyang income statement of the company's historical average, while yung sa right side naman ay siyang projected income statement. Yung dalawang income statement na yan na nakikita nyo ay same lang ng pinanggalingan. Meaning, yan ay galing lang sa isang company. So, para makuha yung nasa right side, isa-isahin natin kung paano i-solve yung bawat row. So, first, uunahin natin i-establish ang sales projection. Sa sales, tulad ng nakikita nyo dyan, para ma-solve natin kung paano makuha yung sales projection, ay i-multiply natin yung sales sa raw income statement kanina, which is yung table na nakalagay sa left side, which is 2 million times 120% is equals to 2.4 million. So, ang tanong, bakit 120% ang ginamit pang multiply sa sales? Kasi, yung ini-expect ng millennial company na mangyari sa sales nila next year ay tumaas ng 20%. So, since 20% ang expecting rate ng increasing sales, ay i-add natin yung 100%. Since yung 100% ng sales nila last year ay buong pinagbasihan. Kaya 100% plus 20% is equals to 120%. Next row is the cost of sales. Para ma-solve natin ito, kailangan lang nating i-multiply yung projected sales, which is yung 2.4 million sa 60%. So, 2.4 million times 60% is equals to 1,440,000. Next is kukunin natin yung gross profit. Para ma-solve yun, just subtract the cost of sales sa mismong sales. So, 2.4 million minus 1.44 million is equals to 960,000. The next row na isa-solve natin is the operating expenses. To get that, imamultiply lang uli natin yung projected cash sa 19%. So, 2.4 million times 19% is equals to 456,000. And para makuha natin yung earnings before interest and taxes, kailangan lang natin i-deduct yung operating expenses sa gross profit. So, 960,000 minus 456,000 is equals to 504,000. Then, yung interest expense, di na yan magbabago. As is na yan. Kung ano nakalagay sa unang income statement, ay yun din ang ilalagay sa projected income statement. The next row, earnings before taxes. Para makuha yan, you just need to subtract interest expense from earnings before interest and taxes. So, magiging 504,000 minus 70,000 is equals to 434,000. The next row is the taxes. Para makuha yan, kukunin mo lang yung 35% ng earnings before taxes mo. So, 434,000 times 35% is equals to 151,900. Then, last column na isosolve ay yung earnings after taxes. To get that, kailangan lang nito i-minus ang 35% taxes from the earnings before taxes. So, 434,000 minus 151,900 is equals to 282,100. Then, as you can see here, there is dividend, which is depende yun sa isang company kung magkano. But in the case of Millennial Company, yung dividend nila kada 36% payment ay nagkakahalaga ng 101,600. Because ang meaning kasi ng dividend ay sum of money paid regularly, which is typically quarterly by a company to its shareholders out of its profits or reserves. Or sa madaling salita, ito yung tubo mula sa kita ng company na paghahati-hatian lahat ng mga shareholders. Now, since tapos na tayo sa step 1, dumako naman tayo sa next step. Forecast the statement of financial position. In this step, kailangan natin magawa ang mga sumusunod. Project the assets needed to support projected sales. Project funds generated through accounts payable and accruals and by retained earnings through profits generated. Project liability and stockholders' equity accounts that will not rise spontaneously with sales. Examples: notes payable, long-term bonds, preferred stock, and ordinary shares, but may change due to financial decisions made later. And finally, determine if additional funds needed by using the following formula. Additional funds needed, or AFN, is equals to required increase in assets minus spontaneous increase in liabilities minus increase in retained earnings. The additional financing needed raised by borrowing from the banks as note payable, by issuing long-term bonds, by selling new ordinary shares, or by some combination of this action. So just like the first step, maipapakita rin ako sa inyong two versions ng statement of financial position. As you can see in your screen, there are two statements of financial position here. Yung nasa left side is yung raw or the representative statement of the Millennial Company's historical average. Tapos yung nasa right side naman yung projected statement of financial position. So just like sa income statement, yung left side sa statement of financial position ay siyang pinagbasehan para magawa yung nasa right side, which is yung projected statement of financial position. So para makuha yung nasa right side, isa-isahin ulit natin kung paano isolve yung bawat row. Sa first row, which is yung cash. To get that amount of cash, just simply multiply the 2.5% the amount of sales in the projected income statement, which is 2.4 million. So 2.5% multiplied by 2.4 million is equals to 60,000. Then the next row is the amounts receivable. To get that, just simply get the 20% of the sales in our projected income statement, which is again 2.4 million. So 20% of 2.4 million is equals to 480,000. Next row is the inventory. To get that, just simply multiply 37.5% sa sales, which is again yung 2.4 million. So 37.5% times 2.4 million is equals to 900,000. Then as you can see, the next row is the total current asset. To get that, just simply add the cash, amounts receivable, and the inventory. So 60,000 pesos plus 480,000 plus 900,000 is equals to 1,440,000 pesos. Then in the next row, it said fixed assets. So since fixed asset nga, walang magbabago. Kung anong nakalagay sa fixed asset doon sa left side statement of financial position, ay same lang din yung makikita mo dito sa projected statement of financial position, which is all both 800,000. Then, next row is the total asset. To compute that, you just need to add the total current asset, then the fixed asset. So, 1,440,000 plus 800,000 is equals to 2,240,000 pesos. Ngayon naman, tignan naman natin yung liabilities and equity part at isolve natin. To get the total accounts payable, just get the 12.5% of the sale, which is the 2.4 million. So, 12.5% of 2.4 million is equals to 300,000 pesos. Sa accrued expenses naman, kukunin mo yung 0.5% ng sales, which is again the 2.4 million pesos. So, 0.5% of 2.4 million is equals to 12,000. Then, sa row naman ng accrued taxes, need mo lang kunin yung 1% of 2.4 million. So, kapag sinolve, 1% times 2.4 million is equals to 24,000 pesos. Then, to get the total current liabilities, just sum all the liabilities na nabanggit, such as the accounts payable, accrued wages, and accrued taxes. So, 300,000 pesos plus 12,000 plus 24,000 is equals to 336,000 pesos. And tulad lang ng fixed assets sa may asset part, yung notes payable bank, long-term debt, and ordinary shares ay mag-i-stay lang din sa same amount kung ano ang nakalagay sa pinagbasehang statement of financial position, which is yung nakalagay kanina sa left side, ay yun lang din yung magiging fixed liabilities mo. So, bago tayo dumako sa next row, which is yung retained earnings, let me discuss to you first kung saan ko nakuha yung mga percentage na pinagsusolve natin para makuha yung value ng assets at liabilities. So, kung may naaalala kayong may sinabi ako kanina about sa goal ng millennial company na gusto nila by the next year tumaas yung kita nila ng 20%. So, para makuha yun, titingin ka doon sa representative statement of financial position. Yung nasa left side kanina. Tapos, kukunin mo lahat ng 20% ng mga current assets at liabilities na nakalista. Pagkatapos, i-add mo yon sa amount ng mismong current asset or liabilities. Para malinaw, ganito. Halimbawa, doon sa cash part, diba nakalagay 50,000. Ang gagawin mo, hahanapin mo yung 20% na 50,000 by multiplying it. So, 20% times 50,000 is equals to 10,000. So, yung 10,000 na yan, which is yung 20% ng 50,000, i-add mo uli sa mismong 50,000 kasi yan yung mismong amount ng cash. So, 50,000 plus 10,000 is equals to 60,000. Ganun lang din naman gagawin sa lahat ng current assets and liabilities. Going back to the retained earnings, to get that, kailangan lang natin bumalik uli sa nakaraan. Tignan natin uli yung table na nasa step number 1. Which is yung projected income statement. Yung part kasi ng earnings after taxes na 282,100 ay i-add natin sa 300,000. So, magiging 300,000 plus 282,100, then subtract natin yung dividend amount, which is yung 101,600. So, pag tinotal natin lahat yan, ay magiging 480,500. And to get the overall total, need lang natin i-add ang total current liabilities, plus notes payable bank, plus long-term debt, plus ordinary shares, plus retained earnings. So, magiging 336,000 plus 70,000 plus 150,000 plus 1.2 million plus 480,000 is equals to 2,236,500 pesos. And that's our overall total. And kung natatandaan nyo pa uli yung kanina naming sinabi about sa mga gagawin sa step 2, ang pinakalas na kukunin ay itong additional financial or funds needed o yung tinatawag nilang AFN. Para makuha yan, need nyong tandaan itong formula na to. AFN is equals to required increase in assets minus spontaneous increase in liabilities minus increase in retained earnings. So, unahin muna natin hanapin yung required increase in asset. Para makuha yon, need lang tandaan ang formula na to. Required increase in assets is equals to change in sales times current assets, which is the present, divided by sales, which is the present. Sa case natin, yung change in sales natin ay 400,000. Why? Kasi, di ba yung nasa previous sale, which is yung 2 million pesos, tapos yung nakalagay na sa projected income statement ay 2.4 million. Kapag ipinag-minus mo yan silang dalawa, magiging 2.4 million minus 2 million is equals to 400,000. So, 400,000 na yung current sales natin. Paano naman sa current asset at sa sales? Simple lang. Balikan uli natin yung mga table na pinag-compare natin kanina. Yung mga nasa left side. Hahanapin nyo lang dyan yung nakalagay na total current asset at yung sales. So, since nakalagay na 1.2 million ang total ng current assets, tapos 2 million naman ang nasa sales, ready na yung equation natin for the required increase in asset. So, 400,000 times 1.2 million divided by 2 million is equals to 240,000 pesos. Next naman natin kukunin is the spontaneous increase in liability. To get that, also remember this formula. Spontaneous increase is equals to change in sales multiplied by current liabilities divided by sales. Since nakuha na natin kanina yung change in sales, di na natin uulitin. Automatic na yon, 400,000. And hanapin na lang natin is yung current liabilities at ang sales. Tulad ng ginawa natin kanina, same table pa rin ang pagbabasehan natin para mahanap yung dalawang hinahanap natin. Since nakalagay sa total current liabilities ay 280,000, the sales ay 2 million. Yun na yung lalagay natin sa equation natin to solve the spontaneous increase in liabilities. So, 400,000 times 280,000 divided by 2 million is equals to 56,000. Then, pinakalas na natin kukunin para ma-solve na yung ADF natin is yung increase in retained earnings. To solve for the increase in retained earnings, just remember this formula. Increase in retained earnings is equals to earnings after taxes minus the dividend. And again, para mahanap natin yung earnings after taxes at dividend, ang gagamitin nating table ay hindi na yung pinagbasehan natin kanina, kundi yung table na ng projected income statement na ginawa natin kanina sa step 1. And nakikita nyo naman na ang earnings after taxes dito ay 282,100. Samantalang 101,600 naman yung sa dividend. Pag minus lang natin yan, so magiging 282,100 minus 101,600 is equals to 180,500. Since na-solve na natin ang lahat ng mga kakailanganin natin sa pag-solve ng AFN natin, pagsamasamahin na natin ito at isolve na. So, 240,000 minus 56,000 minus 180,500 is equals to 3,500 pesos. The steps are halfway done, so start na agad tayo sa step 3, raising the additional funds needed. The financing decision will consider the following factors: target capital structure, effect of short-term borrowing on its current ratio, conditions in the debt and equity markets, or restrictions imposed by existing debt agreements. And the last step, step 4, consider financing feedbacks. Depending on whether additional funds borrowed or has raised through ordinary shares, consideration is given on additional interest in the income statement or dividends, thus decreasing the retained earnings. Since tapos na tayo sa projected financial statements, dumako naman tayo sa cash flow statement. So ano nga ba ang cash flow statement?
Cash flow statement is a process sa closely monitoring of in and out of cash in the business. Meaning, sa pamamagitan nito, nababantayan ang lahat ng mga lumalabas at papasok na pera sa isang kumpanya. At hindi lang ito basta-basta pagbabantay ang ginagawa nito. Tulad ng sa accounting, kailangan ito rin ay nakaayos based sa kung anong account transaction ang mangyayari. Para mas malinaw, narito ang isang example ng cash flow statement. This is Miss Amelia Enriquez, laundry shop cash flows for the month of February.
So, as you can see, there are 5 columns and each columns may kanya-kanyang mga nilalaman. First column is the date, second is the particulars, third column is debit, the fourth column is the credit, then the last column is balance. Yung particulars, dito is yung mga detailed transaction na nangyari kada araw. Then, yung debit, yun naman yung mga perang pumapasok sa company. Kung merong perang pumapasok, syempre meron ding lumalabas at tinatawag itong credit. So, after ng journal entry, syempre meron dapat cash flow statement, which as you can see here, mas detailed at himay-himay pa ang mga transactions of account. Tulad na lang ng mga transactions under cash flow from operating activities, sa cash received from customers ay siyang pinag-add yung mga nasa debit amount ng laundry revenue, collection at sa advance payment. Then, since operating activities ang mga payment for purchase of supplies, utilities, rent, salaries, laundry equipment, and repair and maintenance. Kaya kapag lahat sila pinagsama-sama at itinotal, mag-i-equal siya into net cash used from operating activities. And these are also same for the cash flow from investing activities and financial activities.
Kung merong projected financial statement, ay meron din namang projected cash flow statement. For example, let us assume that Amelia Laundry Shop projected 3 months of cash flow of planning, an expansion of her business. Let us say that there is an increase of collection of 25% and all expenses will stay the same. By month of May, Amelia granted a loan amounted 150,000. How much is the cash flow ending balance of Amelia for the month of May?
So, para mas maging malinaw, here's the table for its projected cash flow statement. Since sabi ng word problem, since nagbabalak ng expansion meaning na gusto niya palalo lumaki yung business niya, which is expected na tumaas ng 25% sa collection habang ang expenses lang ay mag-i-stay at the same. At nakita natin dito sa table, may isa ring cash flow na pumapasok which is yung utang niya na 150,000 sa buwan ng May. And based sa computation, Amelia has 343,250 pesos of cash used for expansion of the business. Medyo malaki ang pera na nailabas niya compared sa ibang mga month. Kung ganito ang nangyayari na mas malaki ang pera na lumalabas kumpara sa pumapasok, dapat i-examine ng mabuti ang sumusunod. Number 1. How and when cash comes into your business? Paano at kailangan pumasok ang pera? Number 2. How and when it goes out again? Paano at kailangan naman itong pwedeng lumabas o maigastos? At number 3. Where it has tied up in the meantime? For example, in inventory and equipment. Kaya naman, para maayos yung cash flow ng isang company, ay dapat mas maraming pera ang pumapasok kesa sa mga inilalabas. Kasi doon natin may tutukoy kung kumikita ba ang negosyo o nalulugi ka na.
Since tapos na tayo sa mga statements, let's discuss naman yung about sa working capital management. Alam naman siguro natin na lahat ng negosyo ay nangangailangan ng sapat na puhunan para makapagpatao nito. Ang sa gayon, maging matagumpay ito sa mundo ng negosyo. There are 2 types of capital required by business, fixed capital and working capital. Yung fixed capital ay yung mga long-term investment assets like plant machinery na pwedeng tumagal ng maraming taon, while the working capital refers to companies invest in short-term assets such as cash, inventories, short-term marketable securities, and accountant receivable. At tinatawag rin net working capital that refers to the difference between the firm's current asset and current liabilities. If the firm's current asset exceeds in the current liabilities, the firm has a positive working capital. On the other hand, if current liabilities exceed current assets, the firm has a negative working capital.
Since alam na natin ang work capital management, tumayo naman tayo sa isa pang management system which is ang cash management. So ano nga ba ang cash management? The cash management involves the maintenance of a cash and marketable securities investment level, which will enable the company to meet its cash requirements and at the same time, optimize the income on idle funds. Sa madaling salita, ito yun sa pagsasaayos ng lahat ng pera at funds na meron sa isang kumpanya na siyang trabaho ng isang financial officer. A financial officer has the following specific objectives in monitoring cash balances. First is to meet the cash disbursement needs or the payment schedule para nakaschedule ang lahat ng dapat babayaran. Second is to minimize the funds committed to transactions and precautionary cash balances para kahit papaano natitipid ang pera sa transactions at emergency funds. At ang pinakauli, to avoid misappropriation and handling losses in the normal course of business.
Although cash is generally considered a non-earning asset, business firms must hold cash for the following reasons. First, transaction motive, which cash needed to facilitate the normal transaction of the business. That is to carry out its purchases and sales activities. Second, precautionary motive. Cash might help beyond its normal operating requirement level in order to provide for a buffer against contingencies such as unexpected slowdown in accounts receivable, collection strike, or increase in cash needs beyond management's original projections. Third, speculative motive. Cash held ready for profit-making or investment opportunities that may come, such as block of raw materials inventory offered as discounted pieces or merger proposal. And lastly, contractual motive. A company might be required by a bank to maintain a certain compensating balance in its demand deposit account as a condition of loan extended to it.
Hindi naman cash conversion cycle, which measures how long a firm will be deprived of cash if it increases in investment in inventory in order to expand customer sales. The operating cycle of a firm is mainly composed of two current asset categories: inventories and accounts receivable. Sum of the average age of inventory and average collection period. Average age of inventory refers to the time that lapsed when a good manufactured and eventually sold. The average collection period, on the other hand, refers to the time when the sale made and collected, which is both measured in days. In the process of producing and selling goods, firms would incur obligations for purchases of raw materials or finished goods on account, which result is account payable. Account payable reduces the number of days a firm resources has tied up to its operating cycle, including accounts payable in our earlier equations, give us the firm's cash conversion cycle. Measures as a difference of the operating cycle to the average payment method. Average payment period is the time that it takes for the firm to pay its accounts payable, expresses in number of days. To make it clearer, here's the example of it. We had an average age of inventory of 18.5 days, an average collection period of 48.5 days, and an average payment period of 53.5 days. Operating cycle. Just add the average age of inventory and the average collection period. 18.5 days plus 48.5 days is equals to 67 days operating cycle. To get the cash conversion cycle, just subtract the operating cycle to the average payment period. 67 days minus 53.5 days is equals to 13.5 days conversion cycle.
If there's cash management, inventory management also exists. The objective in managing inventory is to convert it as quickly as possible to cash without losing sales due to stock outs. Therefore, the financial manager plays a crucial role in overseeing that the firm maintains an appropriate quantity of inventory. Hindi marami, hindi rin kaunti. Maintaining too much inventory implies that the firm incurs more costs associated with carrying these inventories. However, carrying too little inventory quantities may lead to possible stock outs that could further lead to lost sales and worse, lost customers. In a manufacturing company, there are three types of inventory: the raw materials, work in process, and finished goods. Raw materials are those purchased materials that are not yet put into production, while work in process are goods and labor put in production but not finished. And lastly, finished goods. These are goods put into productions and finished and ready to be sold. One of the common techniques in inventory is the ABC inventory system or ABC analysis. Inventory is classified as A are high-valued items, which should safeguarded the most. B items, on the other hand, are the average cost items that should be safeguarded more than C items, but not as much as A items, while C items are the low cost and is the least safeguarded.
Next management naman na that we will tackle is about the account receivable management. So what is account receivable management? Represent assets of the entity that expected to be collected and thus converted to cash. A firm generally wants to collect its receivables as quickly as possible without losing customers due to imposing the very tight collection procedures. Thus, sound accounts receivable management practices would form three parts: credit selection, credit terms, and credit monitoring. One popular credit selection technique is the use of 5 C's of credit: character, capacity, capital, collateral, and condition. In character, the applicant's record of meeting its past obligation has judged. However, if the applicant does not have any credit history, he or she may be required to have a co-maker. A co-maker is another person who signs the loan and assumes equal responsibility for payment. While incapacity emphasizes the customer ability to repay its obligations in reference to its current financial position or standing. It determines whether the customer has sufficient resources or reserves of funds that it can use to settle obligation. Next is capital, the applicant's net worth, which can be arrived at by deducting total liabilities from total assets. Collateral, which is the amount of assets that could serve as security in event that the obligation is not paid. And lastly, condition. This includes current economic and industry conditions that might affect the customer ability to repay its obligations. The use of 5 Cs of credit will allow the firm to carefully assess the customer ability to repay its obligations along with the level of risk that the firm will be subjected to once it decides to grant credit to the customer. It requires experience to fully assess and review the credit worthiness of customer and subsequently decide. Another use in granting credits to customer is through credit.
There is also called credit scoring, which applies statistically the 5 weights to a credit applicant scores on key financial and credit characteristics to predict whether he or she will pay the requested credit on time. In this procedure, a credit score obtained that reflects the customer's creditor or thinness, reflecting its overall credit strength. The score obtained is compared to a predetermined standard in order to arrive at the decision of whether accepting or rejecting the customer's credit. This method is an inexpensive way to obtain credit ratings to customer. And that will conclude our lesson for Chapter 3. Just like what I said to you before, it's a little bit overwhelming, but you are here now still listening. So again, thank you so much for your ears and eyes for lending it to us. I hope you all learned something knowledgeable. Again, this is Group 3 reporting about the Chapter 3.